Today's video will follow up the one that you watched yesterday based on the balance sheet and income statement, and this will go into a bit more detail. Remember that we are starting with the accounting cycle, which means that a transaction happens, something is bought or sold by the business, and that information is put into the books of the business. First into a book called the journal. That process is called journalizing. Then the information is put into the other book of the business called the ledger, and that process is called posting. We will come to those two processes in another week or so. But we're starting with the end of the accounting cycle. So after the information is put into the books of the business, financial statements are made. And these are the two main financial statements that you see on the screen, the balance sheet and the income statement. Hopefully you're a little bit familiar with them by now, and we'll look at them in more detail today. First of all, remember that the balance sheet for this company, the XYZ company, is like a snapshot. It's a picture of the business on a particular date. This happens to be September 30th, 2019. On that date, we have information about the business, assets, liabilities, and a very important figure called the owner's equity. If this were a corporation, this would be called the stockholders' equity or the shareholders' equity. And we'll come to corporations much later. But the owner's equity means that there is a owner of the business, and his or her value of the business is that amount. So that's the balance sheet, a snapshot. The income statement, though, is a look at what has happened during the last accounting period. In this case, 1 month, the month of September 2019. The company was in business. XYZ company got some revenue, made some sales, and paid some expenses that we'll look at in a few minutes. That results in a bottom line called a net income. Sometimes this statement is called the P&L statement. P&L, P meaning profit, L meaning loss. That's used interchangeably with the income statement. So these are our two main financial statements. After this video, you will have some questions to answer. But let's go back and just review for a moment the balance sheet. It has two sides. Left side will list assets. The right side will list liabilities and owner's equity. And this information on the balance sheet is always based on the accounting equation. At the bottom you see that. The accounting equation is assets equal liabilities plus owner's equity, and the balance sheet is meant to show that equation. Another way of stating it is assets minus liabilities equal owner's equity, and we'll see how that comes into play as well. On the left side, under assets, again, you've had some of this before, but these are typical assets. Cash obviously is an asset, something of value that the business owns. Accounts receivable, as we said earlier, represents the amount of money that people owe to us. Customers charged something and they will pay us back later, and accounts receivable is an asset reflecting that people owe us $97,000. Inventory represents the things that we have on the shelf that we're going to sell, and we have some other assets. Office building, office furniture, computers, supplies, and a delivery truck. These are all listed at their value. So this is the total value of those items. Office building is worth $200,000 and so forth. Total assets then at the bottom with the double line is indicated on the left side of a balance sheet. On the right side then we have accounts payable as a liability. We've had that before. These are typically short-term liabilities, things that we owe. So if we buy inventory and we charge it, we owe that amount of money. So typically accounts payable shows things that we owe in the short term, and we owe quite a bit. We owe $112,000 in accounts payable. The other ones shown on this balance sheet are longer term liabilities. Mortgage simply means we owe a long-term loan on land or a building, in this case the building, $150,000. We owe a loan on the delivery truck, and we owe a loan on the computers. These are longer terms, maybe 3 years, maybe 5 years. A mortgage may be up to 30 years. So one point about what we see on the left and right side, the office building shows on the left side $200,000. That's what it's worth. But we owe $150,000 on that building. So we don't own it outright. The delivery truck, for example, is worth $30,500, but we owe money on it. We owe $21,000. So the asset is shown by its total value, not the net amount. So we have assets on the left, liabilities on the right, adding up to $286,000. When you subtract the $286,000 from the total assets, you get owner's equity. And then when you add those two numbers, you'll get the balancing amount that is shown on the right side, which equals the amount shown on the left side of the balance sheet. So indeed, it is in balance. Now, I want to pause for a moment and go back to a situation that you had last Friday. On the 27th, you had an assignment. If you looked at my comments on that, some of you, most of you, were a bit confused with a couple questions on that assignment, and I want to show how this works. Question number 5, way back last Friday, dealt with a situation where inventory was purchased for cash, and my question was, what's the effect on total assets? So if I have a company like XYZ and we buy more inventory and we pay cash for it, how does that affect total assets? Well, most of you said it increases total assets. Let's take a look at this though. If we, for example, let's say that we bought $400 worth of inventory in addition to this $116,000 we already have. So we buy $400 more. So let's put that in. So now we have $116,400. However, the question back on last Friday said that we pay cash for this. If we paid cash, that means our cash goes down by the same amount, $400. So that leaves us with this $83,000. And we end up with the exact same amount. There's no effect on total assets. One asset went up by 400, the other asset went down by 400, so it stays the same. So that's how that question should be answered. Now let's go back and put in our original numbers, 116,000, and we had 83,400, I believe. And so that's where we started. The second question in that assignment last Friday dealt with buying more inventory, but we charged it. And that question said, what's the effect on the owner's equity? So we buy $400 more of inventory, let's say, and we charge it. So what happens to inventory? If we buy more, it went up. Again, 116,400. However, on this side, accounts payable would also go up, correct? We owe more money. So instead of 112,000, 112,400. And if you look, the owner's equity didn't change at all. The bottom two numbers did. They still balance. However, the value of the business did not change. We got more inventory. We increased the assets, but we also increased by the same amount the liabilities. So the effect on owner's equity is not changed. Okay, so if you need to review this, you can pause this video, go back and listen to it again if you need to. A very important concept here. Okay, let's get this back to where it was. Okay, now let's take a look at the other statement. Here, the income statement. As you learned yesterday, the income statement shows two basic things, and then a subtraction of those two. We see revenue and we see expenses. So this company sold $14,000 worth of their inventory during the month of September. And we have a list of expenses. We have salary expense, rent expense, and so on. Now, first of all, let's take a look at expenses in the income statement and over here, the liabilities in the balance sheet. It's important that you are clear on the difference between liabilities and expenses. They sound alike, but they're a little different. If you look at liabilities, every one of these liabilities are things that we owe, but in return we got something. So we owe money for a company building, but we got a building. That's an asset. We owe money on a delivery truck, but we got the delivery truck. That's an asset. Same way with the computers. We owe money on computers, but we got the computers. So a liability in the simplest form means that we owe money for something of value. So in exchange for a debt that we owe, we got an asset. That's a liability. All these accounts payable could be for various things, but it could be that we bought inventory, which is an asset. So all of these things are things that we owe because we got an asset in return. Not the case with expenses. These are things that, as your video said yesterday, these are things that are the cost of doing business. So first of all, salary expense. We have to pay our employees. We do not own our employees, but we have to pay them. That's salary expense. Rent expense. Now, how is that different from over here? We have an office building, but this is a building that we rent. We don't own this storage building. We rent it. So we pay $2,000 for rent expense. Now, if you're explaining this to the owner, he or she may ask, is this rent for a week, for a month, for a year? Well, it's very simple to answer that because at the top it says for the month of September. So this is a monthly rent expense that we have to pay. Same way with salaries. This is the monthly salaries that our employees earn. Advertising, gas, electric, heating, all of these things are not purchased in exchange for an asset. It's simply money that keeps the business going. So we have a delivery truck, but we have to have gas and oil to run the truck. So that's an expense. These are simply costs of doing business. So it's important to know the difference between a liability and an expense. Total expenses, here is the addition of these numbers. And when you subtract total expenses from total sales, you get the net income. Now, if total sales had been 4,000, obviously we would have lost money, and then obviously not a good thing. So that's important to understand how that works. And the last thing I'll mention in this particular example is that if you are the accountant for the business and you need to explain all of this to the owner of the business, it's important that you are able to do that. And you have to analyze sometimes what these two statements are showing to the owner. For example, we have inventory of $116,000. We have sales of $14,000. Now, you might want to compare that with last month. Did sales go up? Did it go down? We have an awful lot of inventory, and we're not making a whole lot of sales. So that might be something that the owner wants to look at. Again, we're looking at a small business, and perhaps the owner is the accountant. He or she may not only own the business, but do the bookkeeping as well. So if it's a bigger business, certainly if it's a corporation, the owner is going to rely on the accounting staff to interpret all of this for him or her. So these are very simple examples, but very important that you understand the difference in how the balance sheet and the income statement interact. At this time, there are some questions that I have for you to answer, so let's do that now.